Yo, I'm Brendan, and today we found out that Robinhood is getting sued. Let's talk about why this is happening, what problems the SEC has with Robinhood, and what this could mean for us as investors going forward into the future. So let's start from the source and unpack exactly what happened. This is Robinhood's website showing that they're getting this Wells notice from the U.S. Securities and Exchange Commission. If you're like me and you don't speak SEC, a Wells notice is just a letter that is sent by a regulator saying that we've finished up an investigation and we've basically made a decision. And in this case, the decision they decided to make was to file an enforcement action against Robinhood. The whole reason the Securities and Exchange Commission exists is to protect investors. Whenever the stock market crashed in 1929 and we were in the middle of the Great Depression, America basically realized that we need to protect investors and not just let people run rampant and do whatever they want in terms of providing investments. So in 1934, the SEC was formed, and if their job is to regulate stuff to keep us safe as investors, what exactly are they doing? What are they regulating? Well, specifically what they're doing is basically monitoring and regulating and controlling what it looks like to sell securities. So why is the SEC all riled up? Why do they care? And why are they disagreeing with Robinhood in terms of what counts as a security and what doesn't? Well, in my eyes, this investigation, this argument, this whole conflict is centered around what is and isn't a security. By definition, a security is a fungible, negotiable financial instrument that holds some type of monetary value. If you're like me, that still doesn't mean anything to you. According to this report from the International Monetary Fund, crypto assets in particular can sometimes be fungible and sometimes not. If you're like me and you forget what fungible means pretty much immediately after you hear it, it means that it's the same thing as another version of itself, that it can be replaced by something of like value. So think about this, $1 is fungible. Any $20 bill is worth the same amount of money as any other $20 bill, as long as they're not like damaged or covered in drugs or something. The fungibility means that they're interchangeable. Ooh, this is fun. Fungible comes from the Latin word fungilibus. Tell me that doesn't sound like a Harry Potter spell.
Fungilibus! Fungilibus! Protego!
Wait until my father hears about this. And that Latin word means to enjoy with the same sense. So you can enjoy this $20 bill as much as you can enjoy this $20 bill. Or maybe you find like a really good diet ice cream and you can enjoy it with the same amount of enjoyment as you would real ice cream. I know it's a terrible example because any diet ice cream is not as good as real stuff, but in theory, if that existed, it would be fungible. So a kind of crypto that would be fungible would be divisible and not unique. It doesn't have like a unique identity. As a person, you are not fungible. I can't divide you up into pieces and just kind of piece you out into equal parts and have you be the same as pieces of someone else. So in this case, Bitcoin and Ether are examples of fungible crypto assets. One Bitcoin, one $20 bill, is equal to any other Bitcoin or any other $20 bill, and it can be divided into equal pieces. The other version of this, which you've probably heard in the news, non-fungible crypto assets, which we commonly call non-fungible tokens, are unique. They're non-divisible. They're like you. You are unique. There is no one else in the world like you. I can't cut off part of your arm and say, this part of your body is worth a proportional amount of your whole body. It's a very grotesque kind of example, but that's what I thought of. And so if you stick with that definition, it seems like that would be a pretty easy thing to avoid. And Robinhood has done work to try and avoid anything that is fungible. Remember, they're claiming that their stuff that they have in terms of crypto assets are not securities. So they need their stuff to be not fungible. Now, Robinhood definitely had cryptocurrencies that were flagged previously by the SEC. And whenever Coinbase got sued, they removed them. They delisted them from their platform. Solana, Polygon, Cardano, all got removed because Robinhood basically wanted to duck and dip and dodge another lawsuit and not get into the same trouble that Coinbase had. So in Robinhood's eyes, they have avoided those things that have been hot button issues before. They just delist them. They try and avoid the problems, but the SEC still uses this test from 1946 called the Howey test, and they're alleging that by using that test, the things that are found on Robinhood's crypto site are actually securities. The Howey test says that an investment, whatever it is, crypto or otherwise, can be regulated as a security if these four things are true. If there is an investment of money. With crypto on Robinhood? Yes. If the investment is made into a common enterprise. And the SEC says that most of the time, whenever they investigate any kind of digital asset, they're saying it's in a common enterprise. They're saying it has a distinct element of an investment contract. The third leg of the Howey test is that investors are expecting to make a profit from their investment. The way the SEC labels this as reasonable expectation of profits derived from efforts of others. And that fourth leg of the Howey test is that any expected profits or returns are due to the actions of a third party or promoter. So an active participant, somebody who's involved involved in the actual running of the crypto asset, somehow managing it, adding value to it. They're the active people. When you're an investor and you get to benefit from the actions of those people, and you have a reasonable expectation of doing that, passes the test. And this is the trickiest part of this whole test, and the things that are probably going to create the most arguments between Robinhood and the SEC, because there's so much nuance here. It's all about, how is this product marketed? How is this product delivered in terms of an asset given to the investor? How is the structure of the digital ledger network set up? Is it operational? Is it ready to go? Is it meant to be used as an asset to meet the needs of the users? Or is it meant to feed speculation to its value? And there are pages and pages on the SEC about what determinations have to be made to know if this is happening or not. And so imagine going through all of that minutia and figuring out how each of these digital assets has been marketed and put together, and how it's meant to be used, and how all of that fits with hundreds of different crypto assets. This is going to be a nightmare. And maybe that's what the SEC has been doing. Maybe they have a list of assets that are failing the Howey test, and it's not meeting their expectations. So it's not as simple and clear cut as it might seem to say, this is a security, this is going to be regulated, this is something that Robinhood probably wants to avoid, versus that thing over there that's definitely not a security, and it's not a big deal for Robinhood to sell it and to make money off of it. Of course, it behooves Robinhood to believe that what they're doing is right, that they don't have any securities, that they can go on having us buy and sell and do everything we do with crypto on there. Well, not we, I don't use crypto, because they're making money off of it. Every time you trade, you're giving them money. And crypto itself is paving the way for what could be happening with the stock market too, which is 24 hours of trading. No matter what time of day it is, no matter what kind of drunken stupor you might be in, you can buy and sell and trade crypto. So what does this mean for us as retail investors, as people who might use the Robinhood app, sometimes might do some crypto stuff, and how is the SEC potentially going to change things? Because what we've seen in the past is when the SEC gets involved and legislation happens against a crypto brokerage, other people have to respond. If you don't respond, that's just kind of business suicide, so it would be ridiculous not to. And so what's happening with Robinhood is going to have ripple effects throughout the whole market. Well, I see this as a tricky thing because to a degree, we do want the SEC to regulate. We want them to be involved and protect us because that's their job. We are not as smart and savvy and quick and tech forward as brokerages are, because they're on the bleeding edge. They know where they can kind of shift things ethically in a direction that benefits them, even if it hurts us. And they're okay doing that a lot of the time. And the people that are working there are clever enough to know what lines not to cross. Robinhood took the Coinbase lawsuit and they said, we need to delist those cryptocurrencies. Robinhood also prohibits cryptocurrency earnings from lending or staking, specifically because the SEC says that lending and staking are securities. So you have to keep it as crypto. You can't transform it into lending and staking. They're trying to walk the line of doing everything they possibly can and not putting a toe over and getting in trouble with the SEC. And this is the way that these kind of developments always happen, because technology and industry and business always advance faster than the rate that laws and regulation and regulators can keep up with. Their job is to monitor stuff, not to be on the bleeding edge. And so there will always be a lag time between something new that comes out and a regulator or a safety precaution or something else that protects us as the end user from catching up. Maybe it's a year, maybe it's 10 years. That's why there's things like pharmaceutical drugs that get released and then years later get taken back off the market because they're not safe. That's why the crypto world ran rampant and wild and crazy for its first 10 years or so. And only now are we really seeing more steps to regulate and make things safer and protect us as investors. So we are caught in the middle of that tricky decision making, because when something new and interesting in the investing world first rolls out, there is a first mover advantage. If you are an early adopter in some of these bigger cryptos, there's a chance that you are a millionaire, or you're retired, or you're currently shopping for a Lambo and watching this video for some reason. Get back to picking out your paint color. But for the rest of us, the big question that we need to ask ourselves is, are we willing to risk our money, our livelihood, our life savings to be as part of that first mover advantage whenever something new comes out? Because at that point, we have to be willing to accept the fact that we aren't protected by any kind of regulator. Nobody's coming to save us. Nobody's making sure this is right. And I imagine some people watching now have felt the sting of that level of unregulation when it came to the crypto world. FTX happens. Things fall apart. There was no structure set up to protect that industry and the people in it and the investors involved in it. And so collapses happen. If you're the kind of person that wants to gamble your livelihood and potentially benefit from that, and you're willing to accept the opportunity alongside that risk of everything collapsing, then by all means, do what you do. You're probably the kind of person that would lament the SEC being involved here. You don't want regulation. You want it to remain the Wild West because you feel like that's where you have an advantage or a chance. But personally, I think that for the majority of us, we should welcome the SEC's involvement, because if we're not willing to bet the farm on everything happening just the way we want it to with crypto or whatever other new technology is coming out that we might want to invest our money in, we actually want the guardrails of the SEC to come around and say, hey, these kinds of things need to be controlled in a particular manner because they actually are securities. They matter. Regular people could be hurt if we don't regulate these, and so they are within these channels now. When something is non-fungible, like an NFT, like a Bored Ape or whatever else, the SEC has no power, no regulation, and then you have nobody looking out for you. You can be completely taken advantage of, and I think for the regular person, that's a bad posture to take, especially now. We are not in the heyday, in the early days of crypto. This is not a gold rush. This is not a big golden opportunity. We're well into the adulthood of crypto at this point. And so personally, I welcome the SEC's regulation. If I had perfect 2020 hindsight, I would have bought Bitcoin. I could have gotten all the finest burritos and race cars in the land and been a happy little boy. But since I don't have 2020 vision, and I don't necessarily think the ends always justify the means, I didn't do that. So I'm stuck with the occasional burrito and the rental race car every couple years or so. And I'm happy with my decision-making process in the meantime because it's both benefited me in terms of growing our net worth and protected me against the downside, which is one of the core foundational aspects of what it means to grow your net worth. Number one, don't lose money. Number two, grow the money. If you want to know more about our strategy and what you need to know about the stock market to get a net worth of over $1 million in your 30s like my wife and I did, then check out my investment class that's in the description below. And if you like the video, the secret comment word for today is porcupine. More Robinhood videos are linked for you to watch next here. And otherwise, I'll see you guys tomorrow.